Hello, so this is hybrid accounts. We're going to study IFRS 5 called non-current assets held for sale and discontinued operations. Now, when you study the IFRSs, you need to know why you are doing that. You need to know the reason why you are studying, right? There are several standards explaining how to treat non-current assets, right? For example, there is I-16, that is PPE. There is IS-40, investment property. A lot of standard. There is I-38 that speaks of intangible assets. Of course, financial instrument speaks of financial assets. A lot of spoken about different standards, right?
Yes.
Yes. But now, when you find that you have this standard, it's called non-current assets held for sale. We say that when you have non-current assets, and there are conditions for which you can say that I'm holding it for sale. The assets which we hold for sale, we call them current assets, right? So
Yes.
same applies. If you have non-current assets and you are holding, they qualify as being held for sale, then we say that these are non-current assets held for sale and they are treated as current assets, right?
Mm.
Yes. So if you do that, then you can, that's why normally these non-current assets held for sale will not be depreciated because they are now current. Okay, now let's go further and see. And then we'll see something called discontinued operations. It might be a company maybe, and maybe you have decided to curtail the scale of your operations, and so maybe some operation may be stopped. Let's say some branches. Let's say you break down some branches, and then maybe you stop working on those branches. Let me say that there is an operation that has been discontinued, so no issue. Later we'll see what we mean by discontinued operations. All right. So as you see, the name of the standard, the objective here is to set out requirements for the classification, measurement, and the presentation of non-current assets held for sale. How do we measure them? How do we present them in the financial statements? Right.
Oh,
Yes, in particular requiring that such assets should be presented separately on the face of the statement of financial position. If you have PPE, for example, it is classified as held for sale. You cannot put it in the same line as PPE, which are still non-current assets, which are still actually not held for sale. You have to separate them. But also it speaks of discontinued operations. So it speaks of rules for presentation of discontinued operations, in particular requiring that results of discontinued operations should be presented separately. Should be presented what? Separately in the
definitely.
statement of profit or loss, which means that if let's say in the year you have earned revenue of 20 million, but maybe 4 million of revenue were earned from the operations that are not going to be stopped, that have now been discontinued, right? You need to prepare two separate portions in the statement of profit or loss. That means you'll write continuing operations and write revenue of 16 million, and then under discontinued operations, you will say you have a revenue of 4 million. So that the users of financial statement a true picture of what to expect when they do invest in your company. Or if they already have their shares, let's say what to expect if they still hold their shares. Or maybe if they say, oh, this revenue was high, but actually, most of this revenue was generated from the operations that have now been discontinued. So I cannot still leave my shares in this company. Let me sell them and invest elsewhere. Right. So we are just trying to do the proper presentation so that the users of the financial statements get the perfect information, the better information, so as to make their decisions. Right.
Okay.
Yes, so we can proceed here and we say classification of a non-current asset as held for sale. When can you say that this non-current asset has qualified to be classified as held for sale? It's just easy. That's why I say an entity shall classify it as held for sale An entity shall classify a non-current asset or this actually later we'll see the meaning of disposal group. Don't worry about that. It's like yesterday when we were studying impairment, we say that we can have asset or we can have CGU, cash generating unit, right?
Yeah.
Now it's the same here. You may have a single current, an individual current asset, or maybe you may dispose, you may have holding for sale something, a combination of several assets with their liabilities, right? So we call that disposal group. So the treatment is just the same. That's why you can see the word non-current asset, but also disposal group, a combination of several assets with their liabilities. Let's say I'm disposing a subsidiary. You can call it a disposal group. So like an entity shall classify non-current asset or disposal group is held for sale if, when can you do that? We say if, right? If its carrying amount will be recovered principally through a sale transaction rather than through continuing use. I need you to understand one thing here. It's not just about studying. You know, if we yesterday we studied the impairment loss. We said that we usually compare carrying amount with what? Recoverable.
Recoverable.
Do you see these two terms here? Do you see? And now we classify a non-current asset if this carrying amount can be principally recovered through a sale transaction. We say that recoverable amount could either be through a sale, which is fair value less cost to sell, or value in use, so through continuing use. Do you see this? Do you see that? Hello?
Yes.
All right. So we say that that one is true if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. You know, if you determine the value in use, we say that you take cash flow at the end of year one, cash flow at the end of year two, at the end of year three, and so on, and then you discount them, right? So
Yes.
if we say that it is held for sale, it means that you do not expect to stay with it for a long time, maybe for more than 1 year. You don't expect to stay with it for a long time, and so the value you can generate very little amount from the value use, such that that value use cannot be able to match this carrying amount. But if you do recover something through a sale transaction, that means you expect to sell it quicker, much sooner. You get that?
Yes.
Yes, that's why when you study the standards, you have to do the connection. You have to connect the dot between standards so that you get the picture of what to expect. Okay. Now we say, for this to hold, the following conditions must apply. So we are studying the following conditions, but just know that our main goal here is that we expect to sell this asset sooner rather than later, right?
Yes.
So we have the following conditions, and they are just very, very normal. Just understand that you need to sell something. So you have the several objects to look at. To understand, to know how to remember these, you have to take that point. First of all, we have the company side, then we have the customer side, and then we have the asset itself, right? Yes,
Yes.
the asset is sold by the company to the customer. We have spoken of three different subjects: company, customer, and the asset itself. All right. See point number one. The asset, you are speaking of the asset itself now. The asset must be available for immediate sale in its present condition. Very, very right. You cannot say that you need to sell an asset and it is not in a sellable condition right now, right? It must be available for immediate sale in its present condition. In its state, you can say that, oh, if the customer would come now and say, I need to buy, you can sell, right? The asset itself is ready. And another point here, we say that the sale must be highly probable, meaning that we say that sale must be highly probable. By the sale being highly probable, that means that there is a high chance that you can sell that. How now? First of all, management are committed to a plan to sell the asset. Of course, management are the one that they will decide whether to sell an asset or not. So management have shown a commitment. So no issue with the management, which is the company side, but also they have a commitment, but also there is an active program to locate a buyer. a buyer is actually being sold. We not just say, oh, I'm holding it for sale, but it is just stay there. But also we say that the asset is being actively marketed at the price that is reasonable. You might be saying that, oh, management is committed to sell. We are locating a buyer, but maybe the asset is worth $5 million, but actually it is being marketed for $15 million. So you find out that, oh, it will be difficult to secure a customer, right? We presume that the customer actually knows the market. You get that?
Yes.
Yes. And so now these are the points are just normal. For example, the sale is expected to be completed within 1 year from the date of classification as held for sale. Of course, this is just the expectation, not necessary. You may expect to sell it in 1 year, but then maybe 1 year passes and they still have that asset, right? So that is just another issue. But that is our expectation. We expect to complete the sale within 1 year, and that's why
Yes.
we call it a current. It becomes a current asset in the statement of financial position. And lastly, it is unlikely that significant changes to the plan. We said that management are committed to a plan to sell the asset. So we do not say that, oh, maybe management may have a plan, but maybe later they change, right? So
Yeah.
since when you're classifying something as held for sale, it is just about expectation. You expect to sell it sooner. We say that it is unlikely that significant changes to the plan by management will be made or that the plan will be withdrawn. So if you see that, oh, management are committed, but the way I see, oh, they'll just change this plan. The way I see they're going to change, or the way I see they'll withdraw this plan altogether. You say, oh no, this is not classified as held for sale. So it's just about the reality, all right? Then after this, let's go and see how to measure these non-current assets held for sale. Okay. Now, for example, here we say measurement. Now we have said that to recognize non-current assets as held for sale, we have seen the conditions above. Now, in order to recognize something, you need to know how to measure it. You need to know at what amount to record it in the books, right?
Yes.
Yes, and so we say it's just normal if you have studied impairment. This is very simple. Non-current assets that qualify as held for sale should be measured at, see now, the lower of carrying amount and the fair value less cost to sell. If you see this, you will find out that it's just like impairment, except that on that recoverable amount, because we say that in impairment laws, impairment of assets, we record an asset at the low of carrying amount and the recoverable amount, right? Because if carrying amount is greater than recoverable amount, then we use recoverable amount. If carrying amount is less than recoverable amount, we leave it as it is. That means we usually record it at the low of carrying amount and the recoverable amount. You see that? Let me do this. Let me do this to show you something. I'm repeating again. If you go back to IAA 36,